Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And I'm going to share this reminder over the next couple of weeks leading into this event. But Jared McCabe, who I think is one of the best buyer's agents in Australia and I, will be live on YouTube on the 28th of May, 7 p.m. And we're going to talk about the top 5 property mistakes that we think we've seen investors make time over time that have cost them a lot of money, maybe millions of dollars, really, if you think about long-term capital growth rates and so forth. A few of these, really obvious ones, but there's going to be a couple in there that aren't so obvious that people tend to overlook. So anyway, I hope you can join us. There's a link in the show notes for you to register for the event. You just need to click on that link and put in your name and email, and we'll then let you know and give you the link to listen in live. So look forward to doing that. Something a bit different. I haven't done anything on YouTube live like that. So anyway, let's give it a go. I might completely mess it up. Who knows? Okay, let's get into today's episode then. And today's episode's really about choosing the right investment option inside super, because I don't know why it's taken me so long to write about this topic, because really, I see a lot of mistakes quite often, common mistakes that people make in terms of messing up super investment options. I just wanted to go through it to talk about, some of those mistakes and how to avoid them, but really, what are the options and how should you choose which investment option you should select. So, of course, hopefully, certainly regular listeners to this podcast will know that around the end of July or early August each year, I do a super fund comparison. So I look at the top 8 industry super funds and share some thoughts, compare returns, and identify a fund or some funds that I think are the best industry super funds out there. This year I'm going to do that. I'm going to add Vanguard Super into that mix as well. Obviously, that's kind of a bit of a new player, not an industry super fund per se, but I think certainly it needs to be added into the mix. So that's good. That gives you which fund. But then the next question then is which investment option. And I would argue that's just as important as which fund, which makes me think, why did it take me so long to get around to producing this episode? Okay, so most funds have what they call pre-mixed investment options. And, things like balanced or growth or defensive. And they're really just talking about, how much allocation is towards growth assets and how much allocation is towards more defensive assets like cash and bonds and fixed interest and so forth. Some super funds will also have life cycle investment options. So that's when you say, well, if you were born in the 70s, this is what your asset allocation, if you're born in the 80s, etc. That can be useful. That's just really another way of sort of guiding people through, again, what sort of asset allocation they should have. And then, of course, a lot of funds also have kind of DIY options as well. So you can put, a certain amount into Australian share market or international share markets, property, all those sorts of things. So they're different options. If we look at the pre-mixed options, I'm going to come back to the other options a little bit later in today's episode. But if we look at the general options, you tend to have high growth, growth balanced or conservative. High growth tends to allocate more than 90% to growth assets. I'm going to talk about, growth assets and defensive assets in a second. Growth tends to be an allocation of somewhere between 75 and 85% towards growth assets. Balanced is 65 to 75, and conservative is typically less than 65% in growth assets. So really, the more you have in growth means the higher the rate of volatility. So you should expect, if you've got a high allocation towards growth, that every time you log into your super balance and have a look at it, the number's going to be different. You're going to have periods of times where it's rising significantly, and there's periods of time where it's falling a lot. And really, in the share market, we should expect a negative year around every 1 out of every 5 years. So 4 positive returns followed by 1 negative return. Just typically, you can, of course, it can be different than that. You could have 2 consecutive years of negative returns. It's entirely possible. But the point is, it's really about volatility. So with regards to choosing which investment option is right for you, well, there's 2 really main considerations, 2 factors that most people should consider. The first one is risk tolerance, and that's really how comfortable are you that your super balance moves around. And I'm going to come back to this one a little bit more in a second. And the next one is time horizon. So if you're only a couple of years away from retirement, then I would argue perhaps capital preservation is more important than investment returns. So that is, if I'm 2 years away from retirement, it's more important to me that I get to retirement with the same amount of money that I've got rather than kind of swing for the fences and lose 30% of it. But of course, conversely, if I'm 30 years away from retirement, so, if I'm early 30s, for example, I've got a really long runway. Certainly, returns are my most important concern, and volatility is neither here nor there. I mean, if I don't need the balance for 30 years, certainly what volatility I might experience over the next 10 years is absolutely irrelevant. Now, one of the challenges for Australians is there are no rules with respect to these premixed investment options. That is, there's no real oversight. They can call it whatever they want to call it. So, I mean, you look at Host Plus's balanced investment option, it allocates 76% to growth assets. That's a little bit more aggressive for a balanced option, whereas Vanguard Super's balanced option is about 50% in growth assets. That's quite conservative for a balanced option. There's a big gap there, right? Even though the name on the tin is the same, what's underneath, what's inside the tin is completely different. And I've noticed over the last few years, there's been a bit of creep towards growth assets. Because the thing is that if I'm a super fund and I have a balanced investment option, I need to publish the return for that. I know that people are going to compare Host Plus's balance with Australian Super's balance with Uni Super's balance. And most people, 99% of them, won't look at the asset allocation. They'll just look at the name on the investment option. So if I'm working in one of these industry funds, I want to make sure I've got as much growth assets inside my option as possible. Certainly over the last 10 years, it would have driven the highest return. And therefore, I can then advertise, look at my balanced option, it's beaten every other industry fund. If I do that, I'm going to attract more money. And if I attract more money and I work in these funds, my job security rises. Everyone does well. Everyone gets paid well. Everyone's happy. And so what's happened over the last 10 years is there's been kind of asset allocation creep, maybe greed to some extent, to try and capture more and more returns and make their products look better and better by comparison. And we just have to be aware of this as Australians because we really need to look under the hood to make sure, well, is it really balanced or is it more of a growth asset allocation? And they're kind of window dressing the returns. And I really think that APRA, which is the regulator for super funds, really needs to come out and say, okay, guys, here's some predetermined, if you want to call it balanced, it's got to be within these ranges. If you want to call it growth, it's got to be within the, to make sure that there isn't this creep like there has been over the last few years. And it's really funny because Host Plus and ART, Australian Retirement Trust, that stands for, that was an old Queensland fund. And you'll see both of these advertised on TV. So they're both well-known sort of brands. They often advertise that they're the leaders within the balanced and growth categories and that they're great, strong performers. And, if you just looked at the data from that perspective, you would go, yeah, okay, I agree, their returns are great. But actually, when you compare asset class performance, so if you compare Australian shares or international shares compared to the other industry funds, they aren't the best performers. So really what's going on here is a bit of a window dressing. Maybe they're using unlisted assets to kind of manipulate their returns and make them look better. Maybe they're using asset allocation as a way of sort of manipulating returns for a particular premixed investment option to make it look better. But I think it's really important to compare apples with apples. And so what I like to do is go and say, okay, how did Host Plus do in the international markets? How did UniSuper do in international markets? Because that's the true investment performance. What's going on behind the scenes in terms of asset allocation can sometimes be a little bit of smoke and mirrors. And I just think that there needs to be greater regulation here. And it's a really important thing for superannuation investors to kind of understand. Okay, next I want to talk about risk tolerance, volatility, and how that should impact your investment option. Because I think volatility and risk appetite is more a education piece than an actual investment preference. So if you're 50 years and younger, you're at least got 10 years through to retirement, which gives you a relatively long runway. In that situation, I would argue that investors should be mostly focused, or I would say solely focused, on maximizing investment returns, even if it means enduring higher volatility in the short term. If volatility makes you feel uncomfortable, then really what I should be telling you to do as a financial advisor is stop looking at your balance, which is not to say ignore your super. That's not it. Of course, we need to make sure we're in the right fund, our fund's performing well, benchmarking, all that sort of stuff. But putting that aside, just don't look at your super balance. It's not actually going to help you because there's this overwhelming feeling that if something changes, we feel like we need to change as a human. We need to change something. It's just nonsense and it destroys returns. In fact, last year I recorded episode 310, in fact, where I spoke about, maybe people in their 20s, 30s, and 40s, and maybe even 50s should invest 100% of their super balance in shares and have no defensive assets whatsoever. The reality is, all the evidence tells us that investing 100% in growth will do two things. Firstly, it's almost certainly going to maximize returns over the long run. Secondly, it's going to be a lot more volatile than having a more conservative asset allocation. But who cares about volatility if we're investing in super? We know the money's locked away. We can't access it until 60. So we really may as well do the best thing we can for ourselves, which is maximize the returns. And as I said before, if the volatility really worries you, you should just stop looking at your super balance. But if I'm here to talk to you about what is the evidence-based approach so that you're going to give yourself the greatest probability of enjoying a comfortable retirement, then it's really 100% growth. And so we really need to think about that when we start looking at investment returns. The other thing with risk tolerance is that it's a really hard thing to measure, because I can ask you in the cold light of day, are you happy with volatility? And you'll tell me, oh, yeah, I know share markets go up and down, it's fine. But really, it's the event that causes the volatility that makes people feel so uncomfortable. So at the moment, it's really Trump's tariffs, what's happening in the US, will there be a global recession? All these sorts of talk. And you can go down rabbit holes online and find articles of seemingly very credible people predicting very terrible outcomes, which is nothing new. It happens every single time there's volatility. And so whilst we all know unemotionally that markets can be volatile, quite often our investment decisions can be shaped by, our emotions rather than logic. And that's why I say, look, the best thing to do is just stop reading. Stop reading anything, stop looking at your balance. It's really not helping. It's really just behavioral finance consideration. Now, I've spoken about, going 100% into equities, certainly for people that are younger. I really should talk about, what about people in retirement too? And I think it depends on individual circumstances and whether you have surplus assets, because people that have surplus assets then have the capacity, that is more money than they'll ever need, have the capacity to adopt a conservative asset allocation, even if it means foregoing future returns. But for someone that doesn't necessarily have surplus assets, on one hand, because their asset position is relatively tight, they should be more conservative because they can't wear the volatility. But on the other hand, and I think lean towards this direction, I think on the other hand is they need to capture all those returns, because if they don't capture those returns, if they are too conservative, then they are taking greater risk. There's a greater probability that they're not going to have enough money to enjoy retirement. So depending on the situation, it still might be appropriate for you to be invested in a growth asset allocation or even all growth throughout your entire life. I'm not saying that's wrong. You've got to think about the risks, but that could be appropriate in your circumstances as well. Okay, I want to finish off by talking about a couple of mistakes that I see that people have made with respect to choosing an investment option, other than choosing the wrong investment option. So, if I'm in my 30s and I've chosen a conservative asset allocation, other than that, what are some of the other things? Sometimes I see people mix two pre-mixed options. So they might have like 50% in balanced and 50% in growth. And I guess the idea is that somehow that they've been able to measure their risk profiles so accurately that they've decided that they're somewhere in between that. They're taking kind of an each way bet. But I'm not really sure that they're massively changing the portfolio construction by allocating across both those. In fact, the way I look at it is I think what you're doing is you're paying investment fees to the super fund. And part of what they're doing, other than investing the money, is the investment committee is receiving information and advice and making decisions around asset allocation. And they're saying, okay, we've got these growth investors. How much are we going to put in the Australian share market? How much are we going to hedge internationally? How much are we going to put in emerging markets? What about property, infrastructure? All these sorts of things. They're making those, let them do their job, right? So you just identify as this is my risk tolerance. This is how much growth assets I want. Then leave it to the super fund to manage that. So I think I would prefer people to just choose one investment option. I think pre-mixing investment options really is going to change the outcome, and you're sort of fooling yourself into believing that you've really changed the asset allocation so materially that you should be more comfortable. Another mistake I've seen is that some people design their own asset allocation. I'll put 40% into the Australian shares and 60% into international shares, for example. Now, I'm not sitting back and saying that's a terrible asset allocation. What I'm saying is no one's managing it. And what we're doing is building, hopefully, a really significant nest egg. And I want to make sure that I have professionals managing that asset allocation. Plus, also in that allocation, you've got really no emerging markets, you've got no private equity, you've got no infrastructure. And there's times where I want to have those asset classes exposures, and there's times where I want to be overweight in some of those asset class exposures. Similarly, what about hedging? There's, currency hedging, for example. Sometimes I want to turn hedging on, sometimes I want to turn it off. And so that's why my preference again is to go, with a pre-mixed option. You might go, for example, UniSuper has a high growth option, which is 100% invested in growth assets. But at least that's a pre-mixed option that you've got, again, an investment committee that's kind of managing the asset allocation and making changes that are accommodating the kind of risks and opportunities that might be present in any particular market. And the final mistake that I see is sort of DIY investing. So there's a lot of industry funds these days that allow you to invest in direct shares and ETFs. The investment menu isn't huge, so it's quite limited. And they do have restrictions on, how much you can put in one particular ETF. But again, I would caution people about that approach as well. I mean, if you understand what goes into developing an asset allocation, the amount of work and analysis and data and professional advice that the super funds get, that their investment committees get, and that they talk about and consider to make those decisions, compared to just your average Joe thinking, oh, I'm going to whack some more money in the S&P 500 ETF. This is an asset that you are dealing with, and the compounding capital growth in that and the performance of that asset over time is critical. I would say, again, leave it to the experts and go with that one investment option that really you resonate with. So I guess in summary, it's really about making sure that you understand, the asset allocation, the different investment options, trying to convince yourself that you don't care about volatility. I think that's really the best conversation you could have with yourself. And be realistic too. If you are really a bit of a nervous Nelly about these sorts of things, well, then just promise yourself, that you just won't look at your super balance, just look at it a couple of times a year maybe, and that's it, and resist the temptation to make any changes. And then if it's appropriate, choose the option that gives you the highest allocation to growth assets. Again, depending on your situation, the only time maybe I wouldn't do that is if you are very close to retirement and you really just can't stomach any major changes in your super balance, or if you've got surplus assets and you really can afford to forego returns in return for much lower volatility. But other than that, most people are probably in the situation where they can wear a little bit more volatility in return for higher longer term returns. Anyway, I thought it was a good opportunity to sort of share those insights. Hopefully that's been useful. Hopefully it helps you. And it's probably a good time this time of year when we're all thinking about sort of super contributions, end of financial year, all that sort of thing, to have a look at your own investment option inside super and make sure it's appropriate. Okay, let's get into some listener questions. First one is from Damien. Loving the podcast. Thanks, Damien. Damien says, I see StockSpot has just released their new super product. Would be interested in your thoughts on this, and will you be including it in your annual comparisons going forward? The separate account structure for tax looks like an interesting innovation, question mark. While I understand the investment options have been around for some time outside of super, how long would you wait for the new fund like this before you get into bed with it? That is, e.g. member service wise, before considering switching? That's a great question, Damien. In fact, there's going to be a lot of new players, I think, in the super industry. BetaShares is working on something. I know that everyone would be familiar with BetaShares, the ETF provider. About 2.5 years ago, Vanguard jumped into the market, maybe 2.5, 3 years ago, something of that order. But I think it's going to be an attractive proposition for most people in the investment market that have a database already of investors and try and get them to move their super monies. Look, of course, there's a few factors to consider. Fees, of course, taxation outcomes, so if it acts like a wrap account in that you're the underlying owner of that asset, therefore you can potentially avoid tax when you convert from accumulation to pension. That'd be a consideration. Investment menu and investment performance, of course, is going to be a consideration. But other than that, there are a few other things that you want to think about. So one of the challenges with a new business in the superannuation space is scale. The reality is they're going to lose money on that product until they achieve a significant amount of scale. And they need to have shareholders that are willing to do that, willing to make that investment. Now, Vanguard has already massive scale, but it's been super challenging for them. I know, speaking to the guys at Vanguard, it's been a really challenging process. They're able to do it though because, they're a massive business and they can make that commitment even though they're a not-for-profit business. But for instance, a long time ago, everyone would recognize the ING Bank brand name. In fact, it's a Dutch-owned bank. ING entered the mortgage market in Australia a long time ago, I reckon nearly 25-ish years ago. Was always a price leader in terms of interest rates, not so much today, still a little bit, but not so much. And it just really had those brand values kind of very similar to Vanguard. And somewhere between 10 and 15 years ago, they thought we're going to get into the supermarket. And they came out with a product that was really, really cost effective. It had a limited investment menu, but it was really cost effective. And we started using it for a whole bunch of clients. Unfortunately, ING gave up after about 3 or 4 years and said, all right, this is not working for us. We're going to have to increase fees. And as a result of that, we ended up having to move clients out. And that's when we moved most of our clients onto Macquarie Wrap platform. And that would have been, I reckon that's more than 10 years ago. So that was a really useful lesson that I learnt at that particular time about businesses trying to build scale in the Australian superannuation market, and that they might all come in with great intentions, but it's really challenging and you're signing yourself up to making a lot of losses unless you can get scale relatively quickly. The other thing too is that almost with their, I kind of like this methodology. Someone told me a long, long time ago, but they said with any product or service that you choose, you can choose features, price, or service. They're the three things, but you can only choose two of them. So you might have something that's really cheap and great features, but the service is terrible, for instance. Everyone would know that's relatively common. Or you might have something with great service, awesome features, but it's expensive. They're the things you've got to think about. So what are you foregoing? If it is cheap, you are going to forgo something. There's no such thing as a free lunch. What are you forgoing? Could be forgoing investment returns. It could be investment menu is really basic. Maybe the insurance options inside super, because remember, having life and TPD insurance inside super is really worthwhile. It could be service. So Damien mentioned member services and the ability to be able to access information, make timely super contributions, receive all that sort of information. You don't want to choose the cheapest provider here because, it could cause you headaches in the long run. So, Damien, we are now starting to use Vanguard a little bit. We didn't want to do that for a period of time. So I think to answer your question, how long would I wait before I switched? I would say at least 3 to 4 years. You want to make sure the product is sustainable. You want to make sure that, they're not going to just change their mind and shut up shop. In 3 years' time, it's just going to be a pain in the neck to sort of move. And that's why the really large industry funds and the really large players like Vanguard just have more scale, more sustainability. And the chances are they're going to be around in 10 years' time. And in fact, the chances are Vanguard is going to be around in 10 years' time and it will be cheaper than it will be today. They've got a long history because they're a not-for-profit business of passing on lower cost. So it's a great question there. I delved into probably a little bit more than I should have, but thanks very much for your question, Damien. Okay, next question is from Jay. Jay says, I just want to start by thanking you for all the content you've put out. I found it to be a big help and have recommended it to a lot of my friends. Thanks so much, Jay, and thanks to everyone that recommends the podcast. The more the merrier. I do put a lot of effort into it. I hope it reflects in the content. And really, the satisfaction that I get is that more and more people are listening to it. It makes me feel good about the content that I'm producing. So, as a favour to me, if you do know anyone that should be listening or might enjoy listening more correctly, love you to share the podcast. Okay, Jay writes, my question is in regards to a small development I'm doing in the eastern suburbs of Melbourne. I'm building 2 freestanding 4-bedroom houses on separate titles and wanted to get your thoughts on whether to sell them on completion and take the GST hit on the new sales or hold them for 5 years to avoid the GST cost. I feel that the Melbourne market will probably do quite well over the next 5 years, and I agree. But would I be better off taking the tax hit now and purchasing something with a higher land to value ratio and holding that new property because holding the new property will most likely underperform compared to, investment grade asset. For context, the houses would be worth roughly about 1.2 each and rent for $800 per week. Awesome question, Jay. Just for context for people, the GST margin scheme tells us that you can claim the GST input credits associated with constructing a property as long as you hold that property for 5 years. There are some provisions around trading stock and how you're approaching these sorts of developments. So don't take that as verbatim. It's quite a complex area. You need to get your individual tax advice, but just generally that's the approach. Whereas if Jay sells these properties, he can claim the GST inputs, but he's got to charge GST on the sales price. Of course, anyone that's bought a residential property knows you don't pay GST on the price. So really that's 10% coming out of his pocket. People are going to determine their market value and Jay's going to have to pay 10% on the market value. So it's kind of eats into the profitability of, developing property and so forth. But it's a great question because, I've done some work on this more recently, but let's think about this conceptually. What's Jay done with this property? Jay's probably bought a very land heavy property. He's probably demolished the dwelling, so he's probably paid mostly land value. Demolished the existing dwelling, he's built 2 individual dwellings and subdivided. I don't know if that's what he did, but I'm just reading between the lines. So what Jay's done is taken a very land-heavy asset, and now he's made a lot of improvements on that asset, and now he has a very building-heavy asset. And we all know from everything I've talked about in this podcast that buildings notionally depreciate over time. So that if construction costs rise and rise and rise, sometimes it can offset that depreciation in terms of cost to replace. And that's certainly been true over the last 5 years. But if you look over the last 40 years, dwellings really depreciate more than they appreciate. So they're not going to be worth much more. They're not going to give you any capital growth. It's really the underlying land value that gives you the capital growth. But most of your investment is really represented in improvements rather than land value. And therefore that affects its compounding capital growth. And the best example or best indication that it's mostly building value, it's mostly improvements, is the rental yield. Jay said $800 per week on a $1.2 million value. That's about 3.5%. Well, for an investment grade property, you're going to get somewhere between sort of maybe if you're lucky, 2.5%. So you're getting a lot higher rental yield on this property compared to a high land value property, an investment grade asset. And so therefore we have to assume that because we've got just mathematically, because we've got less land value as a proportion of the overall value, our long-term capital growth rate has to be lower. So it says to me, yeah, of course, we should take our money and run. If our goal is to build the greatest amount of wealth, then in say 10 or 20 years from now, then selling this asset, taking the equity and reinvesting that equity in an asset that's got the fundamentals to drive a substantial compounding capital growth rate over many decades will be the solution here. Whether Jay does that really depends, I guess, on his situation in terms of cash flow, borrowing capacity, other assets, other investments, all these sorts of considerations. And in Jay's situation, maybe, and what he could do is kind of take an each way bet, maybe sell one and keep one. Sell one now, pay the GST, keep one for 5 years and sell it in 5 years' time. In a rising tide, all ships rise. So hopefully the Melbourne market enjoys a rising tide over the next 5 years. And despite the lack of fundamentals, that property still does relatively well in terms of capital growth, maybe not as well as a investment grade asset. And so, if we're going into a growth cycle, which I believe we will be, maybe he won't be too worse off, and he saved himself $120,000 in terms of GST contribution, but he's taken an each way bet in terms of sell one, keep one. I would take that approach probably if I had the capacity, both in terms of borrowing capacity and cash flow, to still go and buy a investment grade asset. So I'd probably stagger my exit from that property. But great question, Jay. And it is really something that anyone that's developing property really needs to think carefully about. Excellent. I'm conscious of time. I'm going to leave it there for today. Please keep your questions coming in. And until next week, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.